Okay, students, we're going to start Chapter 8 now, which is all about fixed assets. And basically what this chapter comes down to is, should a business be able to deduct major expenses and spread those costs out for capitalized expenses over the life of the asset? And in a nutshell, the answer to that question is yes, they should. And that's what depreciation is all about. Okay, so that's what this chapter is going to be about. Okay, here's what we're going to cover: intro to Chapter 8, fixed assets, practice problems, then a homework preview for you at the end. All right, a lot of words here, but basically tangible assets or fixed assets often boil down to property, plant, and equipment. This is where it's most commonly put on the balance sheet, also known as plant assets, and this is often the largest single asset on the balance sheet. One definition of property, plant, and equipment is that these are used in operations, not inventory. In other words, they're not meant for resale, although they can be resold. If a company owns a factory, they can certainly sell it. If they own a fleet of trucks, they can certainly sell those too. But the difference is that these are meant to support operations. They are not meant to be sold as inventory. Like if you were selling clothes, if you were a retailer, clothes would not be depreciable. It's your inventory. Okay, so even though companies can buy and sell property, plant, or equipment, it's generally not considered to be your core operation that you're selling. It's meant to use in support of your operations. Okay, the life of these assets must extend over several accounting periods, okay, be that a quarter or a year or several of those, and you must record all costs spent in acquiring the asset. In other words, if you bought land and built a factory on it, the permitting, the installations, the inspections, the buying the equipment and having the equipment installed and set up properly, all those costs are what's called a depreciable basis. So all those costs can be actually spread out over the life of the asset. All right. Here's what we mean by depreciation. Of course, things drop in value. That's what most people think depreciation means, but there's a very specific meaning here in accounting, because all this means is that whether the asset goes up in value or down in value, we are saying it drops in value, and you get to take that write-off on paper, although there's no real cost to the business. In other words, you drive a car off the lot. They say it drops in value several $1,000s once it leaves the lot. That may be true of the market value, but depreciation is not talking about the market value. The depreciation is talking about its actual book value. In other words, the value on our books, on our accounting records for what it's worth. Okay, so if you bought a $10,000 car, give it a 10-year life, you're going to depreciate $10,000 divided by 10 years. That's $1,000 a year, and we get to take a depreciation expense even though at the end of 1 year, we do not write a check for $1,000 to anyone. We do record it on the books, but it is a paper cost. It's not real cash. So it's a great tax benefit. We get to take the write-off, very legal, but we don't actually write a check to anyone. So it's nice. It's a good deduction of cash. It's good deduction of expenses on our books, and we actually don't have to write a check to anyone. Okay. There's two types of depreciation. Physical depreciation is where something wears out from normal use, like a truck or a house, something like that. Functional depreciation means it just gets outdated. Typically software, computers, things like this often become obsolete just with time, even if it's not used. Okay, so the journal entry, and remember JV is journal voucher, or another way of saying journal entry. The journal entry for depreciation expense looks like this. Okay, you're going to take a depreciation expense of $2,000 for something, and you're going to write a credit to this account called accumulated depreciation. It's critical that you understand this is a very real expense, even though there's no cash. Neither of these accounts is cash. It's not a real expense that we give to somebody else. It is a real expense on our books because we get to take this expense, and it reduces our taxable income and actually does not hit our cash. Accumulated depreciation, it's very, very important we understand this is a contra asset account. In other words, it is linked to the asset, whatever it is, a truck, a factory, a house. It's linked to that asset, but it goes up with a credit instead of a debit. Hence, it's a contra account. Okay, that's the introduction to depreciation. You'll learn more in the follow-on lesson.